Hello everyone, welcome back to the channel. This presentation is brought to you by Synergy Business Advisory, Noida, a multi-disciplinary professional services firm delivering end-to-end advisory solutions. Today we are discussing an important judgment of NCLT Jaipur bench under the Insolvency and Bankruptcy Code 2016, which clearly explains what amounts to an undervalued transaction under section 45 of the IBC. Can a company sell inventory worth several crores for peanuts just before initiation of insolvency? And can the management simply say the goods were damaged without any proof? The relevant case is Seattle Electronics India Private Limited versus Pankaj Sharma and others 2026. Background of the case: the corporate debtor sold its inventory worth several crores of rupees at a very low price, just a fraction of its actual market value. The justification given was that the inventory was damaged. However, there was no proper valuation report, no independent damage assessment, no insurance claim, and no disclosure to banks or financial institutions. The resolution professional challenged this transaction before NCLT, alleging that it was an undervalued transaction under section 45 of the IBC. Before we go deeper into the case, let us quickly understand section 45 of the IBC. Section 45 deals with undervalued transactions. It empowers the resolution professional or liquidator to challenge transactions where the corporate debtor has transferred assets at a price significantly lower than their market value, or assets have been transferred without adequate consideration, and such transactions cause loss to creditors. Importantly, fraud is not required to be proved. If the transaction results in erosion of value of the insolvency estate, the NCLT has the power to set it aside. Key legal issues before the tribunal were: can the sale of valuable inventory at a throwaway price based only on oral or unsupported claims of damage be treated as an undervalued transaction under the IBC? The NCLT Jaipur bench made some very important observations. Mere statement that goods were damaged are not enough. If the inventory was genuinely damaged, the corporate debtor should have obtained a proper valuation or survey report, informed the lending bank, and filed an insurance claim if applicable. The tribunal held that selling assets worth crores of rupees at a fraction of their value without credible supporting evidence clearly leads in erosion of corporate debtors' asset base. Such transactions are prejudicial to creditors and completely against the fundamental objective of the IBC, which is maximization of value. Based on these findings, the NCLT concluded that the transaction squarely falls within the definition of an undervalued transaction under section 45 of the IBC 2016. The sale was liable to be set aside as it caused loss to the insolvency estate and the creditors. The legal significance of the judgment: management cannot justify distress sales merely by claiming damage. Transparency, documentation, and disclosure are essential. Resolution professional and liquidators must carefully scrutinize such transactions and seek reversal where value has been siphoned off. This is CA and IP Praveen Agrawal thanking you for watching. I hope this presentation will be helpful for you. Please subscribe to the channel for more such informative videos. Thank you.